Before I go to some of the questions that we put together, something has been bothering me since the last panel when Charles said that high net worth individuals, India, Indonesia, Singapore, want their money back in 30 or 15 days. Is that true? Is that what you said? Huh? Were you at that last panel? No. Okay. Well, pretend you were. This is what he said. Is that we don't want to be taking away an impression if it's not true that the high net worth individuals in Asia Pacific have no appetite for illiquids. So maybe we could turn the question around. What is the appetite for illiquids for your private bank clients? Yvonne?
The reality of it is that real estate is a different animal altogether. I mean, generally clients are passionate about this asset class. I mean, we have seen good times, bad times, and even in a climate like this, what we are seeing is that clients are still looking at acquisition opportunities. Of course, hoping to get distressed assets where possible. So regardless of the situations, our clients will always have a huge proportion of their wealth holding real estate assets, either through funds or on their own.
Just to jump in with my own observations as well, I think broadly speaking that's true to a certain extent in terms of the liquidity requirements of clients, because for example most of our European clients after 2008, the financial crisis, when it came to the alternative investment portion of their portfolio, they refused to be invested in anything that had lock-up for any period of time. So for example, for the hedge fund investments, where the typical liquidity requirement was more like a quarterly redemption, even that was not seen as something that met their new requirements. So moving forward, a lot of the hedge fund investments now, we need to look for instruments that have got monthly liquidity requirements. So it's true on a broad scheme of things. But having said that, I think real estate is, as Yvonne was saying, is a slightly different kettle of fish. And also when you talk to Asian high net worth individuals, our experience is that generally speaking, a lot of Asian high net worth individuals are more inclined to invest in real estate actually, because traditionally that's something that they understand. Intuitively they can understand that, and they're more inclined to invest in that and be locked up in real estate actually.
Okay, so maybe I'll add to that with some data I picked up from Preqin. 80% of family offices invest directly in real estate. 87% of family offices invest in private real estate funds. So that sounds like a fairly high allocation. So perhaps that on one hand we can put that 15-day liquidity aside and say that there is appetite for illiquids. Is that what you see, Keiichi?
Yeah, it is. Among the several family offices which I'm managing directly, for example, particularly they are from Europe and the Middle East, we are advising, and coincidentally a few of them are quite similar in terms of kind of asset allocation within the real estate asset class, like diversification of time horizon, whether something is for the capital value, something is for the yield, also between funds and physical holdings. But I think until last year, they had a kind of hope to see more capital values in the coming few years. But as of now, they have become a little bit conservative and kind of wait and see situation for one, distressed assets, and two, is kind of already developed properties which create a certain yield in certain currencies. So yeah, they still prefer kind of liquidity for the time being.
Actually, Yvonne also mentioned an interest in distress. Is that a theme that you're seeing with your family office clients or private bank clients? That a focus on distress as opposed to perhaps income?
Yep, definitely. I mean, everybody wants to buy cheap. So the word distress is also something that we are... I mean, personally, I'm very cautious about people telling me about distress opportunities. So we are very specific. Also, we look at valuations and discount valuations specifically. And also, this is something that our clients, because they are savvy real estate investors. Like you're probably aware, our minimum entry for our client, for example, is 25 million US. So they are the sort that they will take a longer perspective, and they are sophisticated investors instead of just looking at core asset and trying to get income from the properties.
Chris, you're nodding.
Yeah, so I'll add to that. For us, we are looking for distressed, and currently the focus is actually the United States and Europe. Our view of obtaining distressed assets in Asia is it's quite difficult right now, but it's also our history. We bought in Thailand after the crisis and after the tsunami.
So you're somewhat of a vulture investor in that way, right? Okay. And one of the other things, I mean, okay, so whether it's distress or non-distress investing for your clients, and one of the other comments that came up in the session before this was how nimble family offices, private clients can be when making their real estate investments. And something else I picked up that, there are something like 6,000 family offices globally. And I think if we look at where we are today compared to 5 years ago, they're becoming a real force, family office, high net worth individuals, in the real estate space. I'm sure there are many of you in the audience here, I know we've seen it, where there's an interesting investment opportunity, can't move fast enough, and individuals bought it. So maybe you could step back and think, how do you see this group of investors as a competitive force, again, versus sort of traditional fund managers or other investors in real estate? Ichi?
I think one of the advantages, really big advantage, is flexibility compared with institutional investors. And second, and actually quite simple decision-making process. And particularly it's attractive for opportunities, and also kind of they are not really bound by the strict sort of investment rule like institutional investors have. So that is really a very big advantage, and that is why also kind of vendors or people who would like to attract the money to invest in, it looks really kind of convenient to use the money.
Just to jump in with my opinion on that as well, I think this is a trend that is going to continue moving forward, because there are more and more family offices getting set up, especially here in Asia. And one of the things that the information age has brought about is that the increasing connectivity as well. And I think that's one of the key parts that have really fueled the deal flow, because nowadays people come to conferences, you hook up, you meet up with people, and something gets done out of that. So I think the connectivity part is what is a real difference maker, I think.
Yvonne, you're nodding, so you have something to say about this.
Yep, totally agreeing with them.
Okay. So we have a force of investors, a competitive force for those who are institutional investors. One of the things that a number of private bank organizations will espouse is something called open architecture, which means that they will take their product or someone else's product, provided it meets criteria, and look to distribute that to their client base. I think there are private banks who talk about that and don't really do it, and there are those that talk about it and do it. So I'm going to start with Yvonne on this. I guess the decoupling of the manufacturing and the distribution of the product. And to the extent you can, share with us some of the third-party product that you have been able to raise in the past in an open architecture. Maybe you can't name names, but maybe talk about the characteristics of some of those and the size.
Okay, I'll take it. I think we will share this, I think most of you are aware, we have found, along with what's happening in the world, what it's a common trend for our clients is actually looking strictly at co-investment opportunities, and they are very specific into a single asset rather than a good fund manager with 5 projects in the pipeline and looking to exit 10 years later, that kind of formula that has been very successful previously. I think the importance of getting visibility into what the clients are investing into today is something which we found to be a very good or key success in some of the latest offerings that we have done this year.
Okay. Of that 9 billion, how much of that was third-party product? I'm asking because I think there are people here in the audience who want to understand, can they bring their product to you, one of you, or another private banker, and talk about distribution? Or do you just distribute, I mean, to the extent that you're dealing in funds, distribute house product?
And most of them are third-party products. I think, David, you can have some insights on those that are non-third-party products, given your previous role. So maybe you can add on to share with the audience on that part of the business where Citi was...
Sorry, I missed it. What was that? Sounded like a good question. Got a chuckle.
You can add on about the earlier bits about proprietary and what Citi did before in that business. But most of the okay, jokes aside, the reality is that most of them are actually third-party products, and we are looking at opportunities. That is something that our clients will still have an appetite today.
Okay, well, that's good to know. So let's say you and other global wealth management organizations will entertain taking on and creating a feeder fund. Is that usually the structure? And looking to distribute through your global client base if the product meets certain qualifications. We can talk about that later. Daryl, were you going to add to this on the open architecture issue?
I mean, at Real, we definitely believe in an open architecture. We don't create products ourselves, but instead, if a client has a particular requirement, we can actually customize something bespoke for them. For example, there was a rich family that came to us recently who wanted to acquire a commercial property in Germany. So we basically created the structure for that, put in a couple of holding companies because confidentiality was one of the key issues, so they didn't want to acquire in their own name. So things like that is something that we could do.
Actually, I read somewhere that there's an organization that is trying to pull together multiple family offices to basically go around the traditional fund model and effectively create a fund made up of multiple family offices to invest in real estate. So I read that right. Can you talk about that? Because I think this is very interesting. I think it's another example of that part of the competitive environment that we're dealing with.
I don't think I'm not familiar with the specific ones relating to property per se, but I do know that a number of organizations now in this part of the world where you pool together resources for different family offices, where they share ideas, because basically when it comes to some property deals, for example, perhaps you need a large ticket amount. You pull together different family offices together, and we could do something together. So I think that's definitely a trend and a movement that is starting to happen.
Chris, would you work with other family offices?
We've explored business with other family offices. It's actually easier because there's a common understanding and position. And typically with real estate, not to state the obvious, but the timing concerns are similar. There's no rush to do a deal. There's no time requirement like a fund to exit the property. So there's a long-term view or a alignment of timing. It is I think, quite common for family offices to explore opportunities together.
Do you see family offices creating their own funds?
Well, in my region, I think we see a trend towards this. For example, you have Kun Suchad with the Recap, which is an extension of his family. Ben Cha, HKR Capital, also who has extended his family
He's
business.
speaking next door. If you want to go there instead.
And the Gaos with their fund in Hong Kong. So I think if you look at recent transactions also in the region, there's a lot of activity coming from these family offices. And because they have the infrastructure, it's quite natural for them to seek partners and other investors with their transactions.
Actually, in that regard, we've actually helped some clients set up their own property fund as well. Ultimately, it depends on what the client's requirements are. If the client comes in and says that they're looking to get other investors in, because I think it makes sense if you're looking to get, like, let's say 5 or 6 investors in, you could theoretically set up a fund already. The fund structure might make sense. So it really depends on the individual requirements of the client. If he comes in and says he wants to get co-investors in, then a fund structure might be something that we might suggest that to meet his requirements.
Is that a way to reduce the fee structure? I mean, look, if your clients are going into someone's fund through a feeder fund, there's a double load. And if your clients can create a fund, as you said, to do the investing directly, presumably the operating expense ratio is going to be a lot lower.
Well, definitely.
Is that one of the motivations?
No, definitely. It's not just the expenses that are lower, but I think also in terms of control, in terms of transparency, disclosure, because they are the ones in control. They can basically set up the parameters, and they've got full transparency over what they're going to be investing in. So I think that's a key advantage as well of setting up your own fund.
Control. I think it was in the panel before lunch, someone mentioned that, because they did get into this topic a little bit, which is great, because it gave us a few things to comment on, about, and Yvonne, you mentioned this, the percentage of wealth that is in real estate in Asia high net worth families, okay, and therefore, and they're all experts too. So this reminds me anecdotally of, in my past role, I was asked to speak to a room full of private bank clients, all of which had massive portfolios of real estate. And here I was, this guaylo, standing up there talking to them about investing in real estate in Asia, as if they were going to put their money with us. Well, they ended up putting their money with us, but I think it highlights a point. It's a real challenge for someone who, say, has a fund product in Asia to convince your clients to come into that when they believe they can do it better, right? So if someone has a fund product in Asia, maybe that's difficult to come to the private client side unless there is something unique with that product, like doing some development in China or something challenging of that nature. But what about European fund or US funds? Do your clients have an appetite to put money into US or European fund products? Keiichi?
If it is US European fund products, yes, I think. And one of the cynical situations over the past 3 years when I was heading the global real estate team was because SocGen is kind of French bank. So we expected actually quite a lot of inflow from Europe to Asia, but it didn't actually happen. Maybe because Asia was probably too far or something, but another aspect is that I want to emphasize here is that why family office assigns the external private bank like SocGen or person like me to talk about real estate is a kind of role of non-executive advisor for their own allocation, for their timely manners, and so on and so forth. Not all the family offices, unless it exceeds $2 billion, to say, have real estate specialists in. Of course, I mean, somebody say that yes, I'm a specialist. He is a specialist. He's whatever. But family or kind of patron are really looking for the non-executive role of somebody external to keep monitoring how the internal family office people are managing their money. So yes, I think they really welcome the funds because not always the physical properties attract their own cost control. But of course, there is a problem of where the time frame is strictly controlled, particularly for exiting the investment and so on and so forth. So, yeah, I think generally funds are really welcome. I think, yeah. And in fact, I'm introducing some funds to them as well.
European funds, North American funds?
Yeah, I mean, European property funds, I mean, of course, there are two types, right? I mean, existing funds or new opportunistic funds, right? Well, what we have done recently is the kind of small fund, but investing in a city like Berlin. In Berlin, for example, good residential properties is available at 600 euros per square meter, for example, still. This is quite low compared with other sort of capital of the European leading countries like Paris, for example. Right? So that kind of opportunity was brought by the fund people, and they proposed us to create a fund quickly. Why can't you invest in this kind of money? I brought to the Middle Eastern family, and they took a decision.
So interesting. So this is a sort of a client demand, meeting the client demand, and then creating the product. How much of your business, Yvonne, is meeting the client demand and then finding the product for them?
We have a very systematic process of establishing at least a very indicative demand numbers before we launch a product or even get into the whole operation due diligence and then launching it. So, and what we have found very successful this year was that clients were looking for specific products in the US, as well as London specifically. I mean, for maybe a certain segment for residential, where they feel that the exit for such a fund-like product is actually very, very clear.
London, these are single investments, though.
What we did for London was very unique. It was with a very established fund manager, and we did a club-like structure. Remember my earlier sharing about the fact that the clients would like a very clear visibility of what they're investing into. So what we did was to create a sort of a big boys club where everyone has a soft commitment of X dollar, and they will be given a chance. The fund manager will be showing us at least 4 deals a year, and they will have a chance to either opt in, opt out, or top up on their commitment.
And Daryl, can you talk about in dealing with your clients? Are you packaging product to meet their demand, or is it the reverse? Are you
evaluating product and taking it's basically creating bespoke products. It's more like we don't go into a client to recommend a specific investment, be it property or anything else. Generally speaking, the client comes to us to say that they have a specific requirement. They are looking for a specific to acquire a specific property in a part of the world, and then we look at what's the best structure. We come up with a recommendation. How do we best package it, and how do we best meet their requirements? How do we, for example, minimize taxes? Look for the best ways to go about packaging that product.
Okay. Yeah, you have to be careful about minimizing taxes. That's getting a lot of airplay in London right now. So let's talk about specific product before we open up for questions. Where are you looking to invest for your clients right now? China? India? Where? Yvonne?
We can't ignore China, right? This is the biggest market. But I think specifically we look at to be honest about things, we do have a general perception of, yes, there are a lot of noise on China, but I think what our clients today want, if they're going to put new monies into China, is to hopefully get, again, the whole theme about distress or a discount to valuations. That is something that we have been mandated by quite a couple of the platinum clients who have instructed us to look out for such assets.
I mean, most of our clients are European-based, so generally speaking, they will be investing or looking at investment opportunities in their own backyard. So I would say that Germany is one of the top places that they are looking at this point in time.
What is?
Germany.
Germany.
Yeah, German real estate, because I think the yields there are relatively decent.
Residential?
Both residential as well as commercial. It depends on a specific property perspective. You know, it depends on which one you're talking about. I think, from what I understand, Turkey is quite hot as well.
Turkey?
Yeah, they're also looking at investment opportunities in that part of the world.
You've already mentioned Berlin residential. You, right, yeah. What kind of yield on Berlin residential are your clients getting?
I think it could be over about. I mean, it is still an assumption, but because this is still kind of under the construction. But we actually, I mean, the fund actually committed to make it with a sublease basis of the 7.5%.
And that's, do your clients use a lot of leverage? I mean, Yvonne, if I'm a client, I need 25 million to be a client of Citi, right? But so let's just pretend for a minute. If I was a client, will I have an open line? So if I want to buy real estate or make investments, I can move really quickly because I can draw down debt facilities right away?
Of course, I mean, real estate, the good thing about it is leverage, right? But of course, the good thing is that most of our clients have also been very prudent. They don't take excessive gearing of like 90% LV. What we're seeing is that they usually take a strike between 50 to 60% today.
And will you package up to take development risk for your clients? Will any of you do that? Well, Chris, we haven't heard from you for a while. You have a single client. You are taking development risk, but is that something that your clients prefer? You can go ahead and start, Chris. Then we'll go to Yvonne. Take development risk in for your clients' investment.
Sure, we're comfortable with development risk, and I guess the cost of that is staffing a team that's qualified to do that, and taking a view if we're comfortable with the control and the overall cost for the returns. And in our case, we are. We're willing to do that.
Now, I know, Yvonne, you've worked with some very well-known developers as a way to give your clients exposure to emerging market development risk, but with a strong corporate governance overlay, if I got that right. Yeah, and is that appetite still there?
Yeah, definitely, because high net worth individual wouldn't also want to set up a team just to do development. And if they want to buy just pure assets, like let's say even if to an office building somewhere, they could just buy outright. They don't really need a partnership with a fund who has got development track record.
And to add to that, outside of our headquarters in the UK, we prefer that, to have a strong local development partner.
Okay. First of all, what would you tell your clients then to stay, what are you telling them to stay away from right now? What risks to avoid in the real estate space? It doesn't have to be in Asia. You're not telling them to stay away from anything? Or is that a secret? Okay. All right. I told you they're a secretive group. You're not going to get any names out of them. Okay. Yvonne, I know you had a couple of questions that you wanted to put to the other panelists. Huh?
I think they've been answered.
We've asked them.
Most of them has been answered so far.
Okay. I have a question. Can I ask a question of someone in the audience? I guess so. If it's okay, I'd really like to hear, if it's possible, Mark, could I ask you a question? Because earlier we were talking about family offices that set up funds, and this is something that you've done. Would you be willing to comment on that for the audience briefly?
Yeah, I thought hearing what was said earlier today that the talks were very consensual and people were wondering why they were not able to fundraise easily. And I think if one is to be true to what it would be correct to say that there are other reasons than just the economic situation and the uncertainty. I think there is a degree of lack of transparency at GP level in this region that we don't see elsewhere. To give you an idea, we were able to deploy money with a Nordic fund in less than 30 days. I have been monitoring the scene here for 4 years, and it's hard to find GPs that fulfill basic conditions. You look at their information investment memorandum, trying to find out what sort of track record they have and whether they have been true to the promise they made to their investors. Very often you find that they have said something about certain geographic focus and they have invested 90% of the fund elsewhere. They make representations about certain investments they have done, and when you start the due diligence, you find out that it's other people who have done the work for them. So what I am saying is all too easy to talk about the economic situation and the uncertainty. If we are here, it's because we are interested to invest here. It's just that there is lack of stability of the GP platforms. As is the case maybe elsewhere, but elsewhere it's because of legacy. Here it's because of turnover. And therefore, all those conditions are a barrier for investors who are willing to invest in this region. It's not a question of economic uncertainty only, and would love to invest, provided the GP platforms that are offered,
For those of you who don't know, Mark runs Kilvest, which is a fund-to-fund, but it is anchored by a significant family office out of Brazil. Is that right, Mark? And France? Yes. And I think is perhaps a model of some of the things we may see going forward, where a family office create funds based on their own track record and experience in investing and being able to address the issues that Mark did. Next year, Mark, you're on the panel. Do I have any questions from the audience? Yes.
I'm curious about the panel's view on owning companies listed real estate securities REITs, either as an alternative to or a complement towards direct.
Okay. For those who didn't hear, the view of our panelists on listed securities and REITs as a component for their clients' portfolio in the broader real estate or equity space. Do we want to start?
I could jump in. I think it's a question of investor quantum, because basically if you're a high net worth individual with a big investment amount, you could get the similar kind of yield by investing directly in the property. But if you're a smaller investor with a small investment amount, how do you get that kind of yield? You could either go through a fund structure or you could use a REIT, which could generate a similar kind of a yield target. So I think that it's more it's more of an option for the smaller investors. But I think if you're a big investor, you would do it yourself.
Probably in town, family offices wants to issue the fund to be distributed to the small individual people. Probably, I mean they actually have a certain size of the asset. They want to securitize it and to slice it to the securities, and want it to take a gain by distributing to the smaller investors.
But what about investing in real estate security space for your clients?
Yeah, I think there are, and to answer as part of the gentleman's question, is that for the time being, why the funds feel the difficulty to have money from the family offices, the combination of the situation, maybe some of you have already known this situation. First of all, there are so many opportunities brought into the family offices now. Number two, they are not really doubtful about the economy. Of course, they expect the certain downside risk of 15 to 30% in the coming years, particularly in a region like Europe. But they are quite skeptical for the banking systems, particularly, all of the leading countries and economies are going into the liquidity trap. But also family offices, ultra high net worth individuals used to be damaged by the Lehman shocks and also this European situation. So they know how the bank or kind of bank or mezzanine funds turns their stance, not to keep lending the money in 3 years' time or something. They are quite skeptical for the banking system and the bank's stance. So they are not really attractive to proactively look for the investment opportunities from now. Then they have lots of files receiving from developers, from some banks, and so on and so forth. So that is why it is not that they are lack of money, but they are really kind of wait and see situation because of that. So
so they're being inundated with product, is what you're saying.
I think as Darius said, the listed securities, listed REITs and so on are not really the main product which they want to pick up. Because it's not only the family's wish, but staff wish. They actually want to show some added value rather than what their patron knows. That is such a technical things. In fact, actually, inside the office.
I think the answer to your question is less than 50% probability there. It's not that strong. Okay. Any other questions? Yes, sir, in the front row. I'll repeat the question. To the extent any of your clients are interested in Australian real estate, and if so, sort of where does that interest lie? Yvonne?
From time to time, yes. There are a specific group of clients that like the Australia story. Specifically, there are also the other group of clients who had got concerns over the volatility of the FX. Of the Aussie dollar specifically. So we are looking at a particular group for a launch probably early next year on an Aussie product, but we are not sure as to how sizable that demand is. So we are still monitoring the situation today.
And how will you hedge that, or will you hedge that? Will you hedge that exposure for your clients?
No, we don't.
You will not. Okay. Any other questions?
Maybe from the Japanese investors.
Yes.
They are always looking for the Australian dollar's product, But not honestly, not from Europe or Middle East actually, as far as I know.
Yes, good. That's right. Yes, very strong interest from Japan and Australian property. So your clients are net buyers of Australian property. Any other questions? Okay. Good. We've got 39 seconds remaining, so I guess we're on time. Thank you. Please give a hand to the panelists, and thank you for your comments.